Welcome to The Explainer. Today, we're tackling a financial milestone that feels just about impossible for so many people. Getting to that very first $100,000. Why does it feel like you're pushing a massive boulder uphill? And what happens when you finally get to the top?
Okay, so let's just dive right into the big question. You know that feeling, right? You're staring at your investment account in those early days, and you're just wondering, why is this growing so darn slow? Well, I'm here to tell you you're not going crazy. That feeling isn't just in your head. It's a real mathematical and psychological wall that we're going to break down today.
And just to give you an idea of the scale we're talking about here, get this. To turn a single $1,000 investment into $100,000, your money has to grow by 9,900%. That is the sheer size of the mountain you're starting to climb. It's a huge number.
So, this all leads us to what a lot of people in finance call the 100K paradox. And the big idea here is that building wealth isn't some straight, predictable line going up. Nope. It's an exponential curve. And in the beginning, you are stuck on the flattest, slowest, most frustrating part of that curve. And this is where it gets really wild. So many investors will tell you it took them, say, 5 or even 10 years to grind it out to their first 100K. But then, and this sounds crazy, they hit $1 million in the same amount of time, or sometimes even less. How on earth is that possible? Well, it all comes down to 2 big battles you have to win first. All right, so that first battle, it's you against the cold, hard math. In these early stages, that magic of compounding you hear so much about, it's kind of more of a myth than a reality. The responsibility for making your account grow rests almost completely on your shoulders. So think of this grind as a two-front war. On one side, you have the quantitative stuff, the raw numbers, the math of your money. And on the other side, you've got the qualitative stuff, the battle that's happening inside your own head. Let's tackle the math first. And wow, this chart just lays it all out, doesn't it? Let's say you do an amazing job and you save $12,000 in 1 year. Well, a pretty good 10% return on that small, growing portfolio might only kick in another $1,000. That means your personal effort, your savings, is doing more than 90% of the work. You are doing almost all the heavy lifting. So here's the key thing to get. Your wealth growth feels linear because, well, it is mostly linear at this point. It's directly tied to what one person called a Herculean effort to just save month after month. That exponential power of your money making more money, it's just a whisper right now because your capital base is just too small to shout. Okay, now for the second front. And honestly, this is the one that takes most new investors out of the game. It's the internal battle. It's you versus you, your psychology, your habits, and maybe some not so great financial decisions from your past. You have to understand, when your portfolio is small and it's built entirely from your own hard-earned cash, you are so vulnerable to these mental traps. Loss aversion makes every little market dip feel like a catastrophe. The urge to panic sell, to stop saving, or to chase some risky get-rich-quick stock because you're getting impatient, that temptation is at an all-time high. And then, on top of all that psychological stuff, you've got maybe the biggest enemy of early wealth building: financial friction. We're talking specifically about high-interest debt. It's like having a powerful engine that's stuck in reverse, actively working against everything you're trying to do. I mean, just look at the math. It's brutal. You're fighting tooth and nail to maybe get a 10% annual return from your investments. But meanwhile, your credit card with its 25% interest rate is just quietly bleeding you dry. It's like trying to run up an escalator that's going down 2.5 times faster than you can climb. It's a fight you just can't win. But, and this is a really big but, here is the good news. If you can master your savings, if you can conquer those psychological demons, and if you can get rid of that financial friction, you will, I promise, eventually reach a truly magical moment on this journey. It's a moment called the crossover point. And this isn't some vague feeling or a fuzzy concept. It's a hard, mathematical line in the sand. It is the exact moment when your money officially starts working harder than you do. When the return from your investments brings in more cash than you're saving each year.
Okay, and check this out. This table shows you the payoff for all that grinding. For 9 long years, your personal savings of $12,000 is the biggest thing moving the needle. But then, look at year 10. For the very first time, your investment return, at over $13,000 is bigger than your savings. Boom, you've done it. You have officially crossed over.
And once you hit that crossover point, everything, I mean everything, changes. The whole dynamic of building wealth just flips upside down. The grind is over. Now, welcome to the acceleration phase.
You know, the best way I've heard it described is like this. You've spent years with all this painful effort pushing a giant boulder up a hill. The crossover point is the very top of that hill. Now that boulder is rolling downhill all by itself, picking up speed and momentum every single year. Your job is just to kind of nudge it in the right direction. And look at how the tables have turned. Remember that first chart where your savings just dwarfed your returns? Look at it now. By year 15, your investment returns are more than double what you're saving each year. Your money is now, without a doubt, the primary engine of your wealth. You know, getting to this stage is about so much more than just the numbers. It's proof of your character as an investor. It's like a form of financial natural selection. You've proven you have the discipline, the emotional grit, and the long-term vision it takes to build real serious wealth. You are a survivor of the grind.
So what does this all mean for you? What's the actionable plan here? If you are in that slow, frustrating grind right now, how do you make absolutely sure you get to the other side? Let's map it out. Look, the path forward isn't some big secret, but it does take focus. First, you have got to attack high-cost debt. Paying off a 20% credit card is like getting a guaranteed 20% return on your money. Second, squeeze every last dollar you can into your savings rate. It's your main engine at the start. Third, have a plan and just stick to it. That's what protects you from making dumb emotional mistakes. And finally, be boringly consistent. Automate everything. Persistence is the only thing that wins this first hardest stage. So the big takeaway here is this: that slow, painful, frustrating grind isn't a sign that you're failing. It's not a bug, it's a feature. It's a mandatory part of the journey, defined by both math and psychology. And understanding why it's so hard, well, that's the secret weapon that gives you the persistence to fight through it and get to the other side, where the real fun begins.